Target missed its target. We're going to talk about Target earnings and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. We talked about Target on Monday. We had a trade on Monday. We can take a look at how that trade has done in light of how Target did on its earnings. I wanted to make a quick point before we get to that. On my screen right now is Target's official results. I'm going to actually try to blow this up so you guys can get a better look at it. Let's try to get this really so it fills up the screen. This is right from there. Investor relations website. This is the portion I want you to try to take a look at right here, which is their comp sales and their stores comp sales. So you can see down 3.8%. Why am I paying attention to this? Because you'll remember that we were taking a look at some alternative data when we discussed this on Monday, and here we are. So we were pointing out this is now, I don't know, the third time that the Placer AI data has given us some sense of what was going on. So year-on-year growth, the Placer AI data for the period ended. Now, this was for the first quarter, so it's not a perfect match, but this was the year-on-year growth for the period ending at the end of April, down 3.4%. Their comp sales down 3.7%. Comp sales is obviously going to measure their actual sales or revenues. This is measuring foot traffic. But again, 3 times in a row now, Placer AI has been better than the second measure. So I think that's kind of interesting and just sort of reaffirms my thoughts that we should make sure that in any retail instance, we're taking a look at that. I think we have a video from the UBS analyst who was on CNBC with Joe Kernan earlier this morning. Maybe we can roll that.
The risk reward for this stock is squarely tilted to the upside. If you take the low end of its updated guidance, which is $7, right now the stock's indicating $95 in the pre-market. That means it's trading at 13.5 times. The broader retail index is trading around 16 times. So Target is trading at a 15% discount to the broader retail index. I don't think you can argue that Target is 15% worse than other retailers out there. Yes, it has had a host of challenges in the last few years. But with that being said, at the midpoint, it's going to earn $8, which is pretty consistent with what it's earned in the last few years, showing some level of consistency. So bottom line is downside is limited. Upside is significant here if it can get it right.
So this is pretty consistent, I think, with our own view. The stock actually hit a low of about 91 bucks. This is on a down day anyway, about 91 bucks, I think, right after they reported closed at 93. We talked about a strangle swap where we didn't quite match the strikes on Monday. And I'm going to just load up that trade. And, you know, what I probably should have done at the time, and I'm going to make more of an effort to do this in the future. So if we come up with any new trades, we're certainly going to try to do that. It was the 75 puts and the 125 calls that we were looking at. And then, if I remember, it was the June 120 calls I've just been told. Again, I'm going by memory. Okay, and it was the 85 puts here. And I think the 115s here. Sell, there we go. Okay. So this trade was about 80 cents or so. I think when we discussed this on Monday, it probably would have opened around there on Tuesday. Oops, sorry. This is a mistake here. There we are. There we are. Yeah, here we are. That makes sense. This trade was about 80 cents when we looked at this on Monday. It's $1.80 now. I'm never crazy about it when options traders say, oh, look, this trade's up, 125%, which is what $1.80 over 80 would be. The reason is because I like to think about returns in terms of the risk that you're taking. So what was the risk? The risk really was the amount that you spent plus the distance between the strikes. If we think about that, right? So 85, 75, and 115.5 on the upside, so about $5. So you take the worst of those two, $10.80. The 80 cents that you spent, plus the fact that the stock could blow right through the 85 and 75 strikes if it went to zero. So that's the absolute worst case, right? So the true way to think about that return is really on your worst case loss, I think is one way to think about it. Still not bad, right? 10%-ish in a couple of days. And it wouldn't have tied up a great deal of capital if you're using a CPM account. I think I had this thing on and it had almost no real capital tie-up to put the trade on. Speaking of trades on, I will just quickly throw out that one of the things I did today, even though it was a down day, I was thinking about doing it yesterday. I wish I had, because obviously the market was weak. I did buy some SPX put spreads. I'm just not feeling too enamored of the market right here. I'm not crazy about the conversation that's going on in Washington around this bill. Specifically, what concerns me is that there does not seem to be any fiscal discipline whatsoever. And, there's this big insistence, we've got to raise the SALT cap, I know they're looking for 40,000. Who knows, maybe we've gotten it or will, even while we're on. I should probably just see if there's any kind of an update. So the most recent thing I'm seeing is White House says failure to pass a tax bill would be a, quote, betrayal, unquote. Here's the thing. A $40,000 SALT cap is a pretty big number, and that has a real fiscal cost to it. And, a SALT cap would benefit people like myself that live in high tax states. And so, of course, selfishly, anybody who lives in California or Illinois or New Jersey or New York and so on, of course, they would like to see a higher SALT cap. But the truth is that what that effectively does is that asks the federal government to subsidize the tax behavior of individual states. And, it's interesting because, of course, they had to sort of get away from the apportionment issue even to pass the income tax to begin with. And having anything that subsidizes high tax states over, lower tax states, it creates an incentive for states to increase their individual taxes, because some portion of those tax increases will come in the form of savings in federal taxes. But we really cannot afford to see these declines in federal tax revenues. We're running a well over $2 trillion budget deficit at this point. And now we're facing a situation where longer-term interest rates are rising, and this is highly problematic. It was Herbert Stein, I think, was his name, who said, something that cannot last forever will eventually stop. I'm paraphrasing, but the gist of it is that if you know something is unsustainable, you cannot pretend that it's not going to come to an end sooner or later. And we can either try to end it in an orderly fashion, or it will end on its own in a disorderly one. And this is what I have to say concerns me. And as I see the long end of the curve creep up, we've got the 30-year over 5. That's a troubling situation, because as longer-term rates go up, you have to discount the net present value of future cash flows for equities. So all else equals, that makes bonds more attractive and stocks less so. And I'm not sure why 5% would necessarily be the upper end of that threshold. So, you put all these things together, and it's a little bit of a risk. And it's not that I think this is a risk to all individual stocks. So somebody else had asked a question, not in the chat right now, but they'd asked me a question about Alphabet and asked, whether, I was still bearish in light of some of the new news. I was very bullish on Alphabet at the beginning of the year, and became a little bit less so as it became increasingly clear that the large language models, the ChatGPTs, the Groks, and so on, were taking some of Google's search business, which is more than 70% of their revenues. But I wouldn't say that I had become bearish on it, because the most recently recommended trade that I came up with for Alphabet on this live stream was actually a short strangle, which is more of a range-bound thesis. So basically saying, look, I think it's going to be bounded on the low side by fairly compelling valuations, at least on a trailing basis, and bounded on the upside by some of those concerns that I articulated, and I kind of stand by that. Okay, so if you did the target trade, you can arguably take some profits here if you so choose. You know, the thing I would say is that these calls right here, these 35-cent calls, they've got more than a month to go. You know, not a terrific rate of return to be had on those. The downside puts, on the other hand, at $1.25, I'm not so sure that I would close those straight away, but you know, you're probably going to want to close those pretty soon as well. Remember that the way we like to think about this is, are you earning an equity-like return for the risk that you're taking? The 115 calls at 35 cents, you're only getting 30 basis points for those over the course of the next month or so. Not a great rate of return. Probably capital could be deployed better elsewhere. So you could arguably, you know, take that portion of the trade off, and if you wanted to, you could take off both legs on the call side. So that would be this and this. Over here, on the other hand, short the 85 strike puts at 124. So your downside risk is that you get put the stock at 85. That's 1.5%. So that's still okay, and you're still insured by these longer dated set puts. So that would probably be the way that I would, you know, consider pairing that. But you know, your mileage may vary. If you want to hold on to those longer dated calls, one of the things you could do is consider putting it into a lower strike call spread. So longer dated calls and short into a kind of a buy right. Make sure that those shorter dated calls that you'd be selling expire before the next reported earnings. Okay, so moving along, Eileen, a regular viewer, thank you for that. And also, I think this is a very good point, because we have talked about United Health. As Eileen says, the news on United Health today was pretty shocking. Paying nursing homes to not transfer patients to the hospital. Where are those Midwestern values? Surprised it didn't revisit its lows. So I had previously mentioned that call spread risk reversal that we had recommended on this, you know, which was the 240, 280, 310, probably deserved to be adjusted. I mentioned that on Monday. In any case, but in light of this, I think that might be even more true. That trade is profitable. Of course, the stock is considerably higher than it was when we recommended it. Not as high now, net of today's decline. We can take a quick peek. But I'm with you, Eileen. I really don't like this kind of news coming out. You know, hearing the kind of you know, more bad news. So we have allegations, so far unproven, but you know, supposedly the Department of Justice looking at them for things like Medicare fraud. You know, hearing this, I guess here's the question that all must ask themselves, and that is that if you start identifying several things in a row, all of which make one question the culture of a business, you have to ask yourself, are these isolated incidents, or are these indicative of what was going on? You know, I can't speak to that exactly, but I will say this. You know, we're starting to see a little bit more of a pattern. We had that trade on. It was profitable. I'm kind of the view at this point that now I'm getting a little bit of distaste, admittedly, and I'm inclined to just sort of take the profits and ring the register on this one. So, yeah, we do have that. Okay. So, moving on, in other news on a weekday, I thought the action in Bitcoin today was also interesting. We can't pull up Bitcoin Cash in options play, but we can bring up IBIT, which is the ETF that tracks it. So here we are, another all-time high. And actually, you know what I should do here? Let me just bring up unusual whales too, because I've mentioned this before, but I figured I probably ought to again, which is that sometimes with things like commodities, you end up with a volatility skew that is, a little bit different than what you get in equities. So typically what we see in equities is that the volatility smile has a lot of downwards, negative skew. So that means that the downside puts are trading at a big premium to the at-the-money calls. We do see that here. It's a risk asset, not terribly surprising. But usually what you also see in equities is that the upside calls are trading at a discount to the at-the-money calls. That is not the case with many commodities because you do have these potential upside or risk situations as well. And one of the things that does do is it helps create a situation where call spreads become more attractive from a risk-reward perspective than they were prior. And since, as all will probably know, I'm generally bullish of Bitcoin at this point. So let me just quickly illustrate a trade that tries to take advantage of this skew dynamic that I'm referring to here. So if you did something like this, let's probably bring that down just a hair, move it over here. You can end up with a structure. So this is, short a put down around the level where we just had this sort of breakout from this sort of standstill rate of return being negative. The truth is that day to day, those wings are probably going to decay at or maybe even a little bit more quickly. So it's not going to really turn out like that until expiration approaches. There's going to be a situation where those wings are going to decay rapidly as a percentage of their own value and relative to the at-the-money call. When they get cheap enough, they'll still be decaying as a percentage of their own value, but they're not going to have that much value. So at the end, basically, that decay starts to go away. But in the meantime, this isn't a bad structure to consider. So things like call spread riskies, I think this is another situation where I kind of like it. And so Monday morning quarterback, Bitcoin traded in the $2,000 range today. I assume ready to break out. Yes, I'm with you. I mean, we got this new all-time high, and all of these other things we've been discussing are kind of in alignment with it. I just don't see this as, it fits into the story, into the narrative, the challenge that we're facing at the moment. So I have liked it. I continue to like it. And so you can, look at strategies potentially like that. So something else I wanted to just quickly touch on, which is the S&P valuation here, because now that we have gotten a good percentage of the earlier losses back, as we can see here, this is a circumstance where I think obviously I put SPX put spreads on today. This was not really so much of a timing issue. It's just, I feel like we're a little bit vulnerable in the sense that we have a lot of these things going on, and we're back up to above average valuations in a rising rate environment. And I'm talking about the 30s really, but presumably the 10s can potentially follow. It's interesting. I just got a text message from somebody earlier today, and they were saying, the 10-year yields have been range bound between 3.5 and 4.5. Buy them when they're 4.5, sell them when they're 3.5, and just use that as a regular sort of trade. And I would say I'm not super crazy about that because I feel like we are at a potential risk for bond vigilantes to step in and say, you know what? Maybe the 10 should be at 5%. Because if you go back and you take a look at long-term 10-year rates, what you're going to see is that what we have experienced over the last, many years, we'll call it, since the GFC, since the Great Financial Crisis, is not the norm. So here we have those rates. I'm just going to throw the GFC in here. So we'll go back. I mean, the GFC really kind of started in late 2007, but the aggressive policy response really didn't start until, we'll call it 2008. So I'll just go into late 2008. We're going to get in here. So that's that. Now, if you kind of consider where were we prior, what was the all-time lows prior to that? This was basically the all-time lows. So you can ask yourself, are we closer at this point at 460 in the tens? Are we closer to the upper end of a range, or are we at the lower end of a range? And I think it depends on how you think about a range. This was an abnormal period. It was a period during which we took on enormous amounts of debt. Debt which we don't seem to have much will or policy prescriptions for trying to solve. And of course, they can artificially depress rates. But if they do, that comes with some very nasty side effects. So I'm hoping that's not going to be the solution. But we've heard Mark Guthner on Fridays when he's come on, when people have kept talking about, oh, rates are going to go lower, they're going to go lower, and he has said that he actually thought that they, would go higher. It is interesting to me when you hear someone like Mark, who has been in the business since the 80s, or someone like Leon Cooperman, who's been in the business since the 60s, when they talk about rates, their attitude is they're going higher. If you talk to somebody who graduated from business school in the aughts, they all think, oh, we're at the upper end of the range. I'm kind of going to go with the age and wisdom on this one. So I am a little bit concerned about that. So PC asks, how can you adapt the core Kelly criterion formula, a one-off bet for options trading, which is continuous and needs a differential equation to express put spreads, and oops, this thing popped down. Put spreads and credit, what is that? SP and an ING. I should probably know exactly what you mean, but I don't. Credit spreading, is that? Put spreads and credit. Put spreads and credit is estimated. Okay. Yeah, I'm not sure what you mean by that. I'm going to just look at your next thing here. 2 for a trade. How do changes in implied volatility impact your estimated probabilities and potential payout spreads? Got it. Okay. Yeah, that makes sense. So put spreads and credit spreads is estimated. Okay. So a couple really good questions here. The first is, it's true when you're trying to figure out how much capital you're going to allocate to a trade, and if you're going to use a derivation of a Kelly criterion to do that. By the way, for people who don't know, the Kelly criterion was a approach that was developed, I assume, by somebody named Kelly. I'm going by memory. I believe he worked at Bell Labs. The idea was, what is the optimal amount to bet on a wager? If you know the odds of a win or a loss, how much you will win if you win, how much you will lose if you will lose, that will maximize your returns over time. And he developed something called the Kelly criterion. You can look it up, actually. I'm pretty sure Grok will have it. ChatGPT will have it. But I believe it's actually on Wikipedia. Yeah, here it is. All right. So maximizing your expected return. Now, we touched on this topic when I was talking about a box stock strategy where one was using put spreads to make a bearish bet, and how I illustrated that the amount that you wager has a huge impact on your overall results, and that the biggest risk you could make was wagering too much. And the reason was that eventually, if you wager too much, eventually you just go bankrupt, right? So your returns go to zero. So if you think you have edge in a trade, you want to bet as much as you can, and then if your capital diminishes, then you have to reduce the amount that you bet, and so on. So this is kind of a general approach to that. PC's other question has to do, and it is quite a good question, which is, first of all, part of what we get for the odds actually comes from options prices themselves. What do I mean by this? Well, let's just take a purchase of a put in SPX, okay? So let's say I'm going to look out, we'll call it 30 days or so. We'll go out to June 20th. And I can roughly approximate the probability that an option is going to expire in the money by its delta. In this screen, because it just looks like a sea of numbers, you probably can't really make it out. In this screen, the delta is represented over here, where it says DM. That's just delta mid. And that means that's the delta if one takes as an underlying assumption that the mid-market price of the option makes sense. Why is this? Well, because the higher the price of an option, all else equal, the higher its delta, the lower price, the lower its delta. So the delta, if the bid is the correct implied volatility for the option, that's a lower probability that it's in the money than the ask is. I hope that makes sense, right? So another way to think about that is that if an asset has a volatility of 0, an out of the money option on either side of it has a probability of being in the money at expiration of 0, because the underlying asset's not moving. It cannot go higher than the call strike. It cannot go lower than the put strike. So if options are inferring a volatility for the underlying asset, the higher it is, the more likely the underlying asset is by that estimation that it runs through it. So part of PC's question here is, how does time decay and how do changes in volatility change the estimated probabilities of various events? And the answer is actually the same for both. So if an asset's very volatile, it could move a fairly substantial amount in a short period of time. If it's not particularly volatile, it could still move a lot over a very long period of time. So the impact of time on the value of an option and the impact of increases in volatility have similar characteristics. All else equal, an out-of-the-money option's delta will go up the further out in time it goes, or the higher volatility goes, which should make intuitive sense. The opposite, therefore, is also true. And the way to think about this is, and let's use a really concrete example. So I'm going to just get rid of this screen. I'm going to bring back because it's easier to construct where's my options play? Okay. So let's just work through this together really quickly. And I'm going to construct a couple different trades with similar probabilities, and then we're going to adjust some of these characteristics to show it. So let's just use a strangle, right? This is something that, I know that the guys at Tasty really like to do. Let's say, for the sake of argument, we're going to look at a 40-day strangle. We're going to sell it. And they like to use, we'll call it 20 to 16 delta options. So on the call side, let's see if I can find one that's in that neighborhood. Oh, there's a 16 delta call. And I'll choose a 16 delta put. Now, what did I just say about delta? The delta is the probability it's in the money. So I'm short a 16 delta call and a 16 delta put. Each of these options, at least as far as the options market is concerned, have a 16% probability that they are in the money. Now, there's another whole part of this which we need to get to, which is being in the money is not the same thing as how much you make or lose, because the Kelly criterion relies on you not only knowing the probability of win or loss, but how much you make or lose. In this case, it could be in the money by a tiny fraction and you still make money. It could be in the money by a lot and you lose. So there's a little bit of noise around the edges. Okay. So this is a 16 delta strangle that expires in 40 days. Well, now let's construct a 16 delta strangle that expires in a week or so. So I'll just go to what day do we have here? What is the date today? Today's the 20th, so 21st. So that it's going to be the 30th, right? So that's going to be next Friday. So here I'm going to choose, I'm going to do a little sale, put it right in the middle. So a 16 delta call in this instance is now the 598s, and a 16 delta put is going to be the 564s. Okay, so take a look at the difference here. 1 week, so in both of these cases, we're looking at a 32% chance that the strangle is in the money. So that means the stock is either through the call or through the put strike, one way or the other. So both of these have the same implied probabilities as far as the options market is concerned. But we can see, and this should fit with our intuition, that the longer dated one, the strikes are much lower. Makes good sense because the chances that it gets through 564 to the downside or 598 to the upside by June, the end of June, is much greater than it is by the end of May. Month different. And in fact, you can even compare these. So these both have the same probabilities, at least as far as the options market is concerned, of being in the money right now. And we can actually compare how this June option package would compare to this one by simply matching the strikes. So I can take this down to 598, which is the call strikes that I have for the other one. And I can take these puts up to 564, like so. And what we can see is that the probability that these calls are in the money, 34%. Again, that's using the options markets calculation, and 28% for these puts. So you put those two together, it's a 62%. So this strangle, which expires in 1 month, has only a 32% chance of being in the money, according to the options market's implied volatilities. But those exact same strikes have a 62% chance of being in the money by the end of June. So that takes care of the time impact. Well, as volatility changes, you're going to get something very similar, right? So if the volatility is smaller, like this, those chances go down. If the volatility is larger, like this, those chances go up. So the next question you want to ask yourself is, okay, is delta a good way for me to monitor what the probability is in real time? And my answer to that is, I think so. The reason is that, especially for something like SPY, assuming an efficient market, that this is the market's best guess. It's taking all of the information that everybody who's betting on the markets at any moment in time has at their disposal. Economic releases, earnings have come out, the market has actually moved. The market might be moving more from one day to the next than it had been, or maybe it's moving less. So in the absence of anything else to use as an input to how much risk you're actually taking, the delta is as good an indicator as any that you're going to find in an efficient market like this. Now, if you're looking at some off-the-run stock that nobody's really trading, then it's going to be a little bit trickier. And I would, there are stocks where very few options trade. Maybe all the trading that did take place was one-sided. So you have nothing but overwriters, so the implied vol is low relative to realized, or you had nothing but buyers and the implied vol is high relative to realized. In those cases, you probably want to look at both. But otherwise, yes, I think this is a reasonable way to think about it. So just to button up that conversation, implied volatility or volatility in general goes higher. The likelihood that an out-of-the-money option is in the money goes up. The likelihood that an in-the-money option goes out of the money goes up. And as time is extended, those probabilities increase. And as it goes down, they decrease. Hope that helps. So one final thing. You're trying to figure out, in order to do the Kelly criterion approach, you need to know how much you make or lose. How do you think about it? Do something like an excess shortfall calculation. So what you do is you take the mean value in the event that you win, compared to, obviously if you lose in a long options position, you're going to lose it all. So that means you actually have to calculate how much you would make at various points and multiply it by the probability of those respective events. This is also, by the way, how a value at risk calculation is done, something called an excess shortfall. So what you do is you say, okay, I think 2 standard deviations, 95% of the time we're going to be in this range, whatever the probability is. So then you can calculate the probability that you fall out of that. And then you need to figure out the mean value of that tail event. And that's, if you use that as your win formula for your Kelly criterion, it's probably a decent approach. That's how I do it. So, I think that's a reasonable way to think about it. PC, I'm not sure if that completely answers your question. It's a pretty deep concept. But, we could probably delve into that a little bit more. Maybe I'll do that when we have Mark. We'll put up a spreadsheet and do a little bit more of the math. But I do like the way you're thinking about it. FinWest, good morning. I've been bullish IBIT. Me too. Have bought a number of shares with covered calls the past month. Didn't expect such a positive move, but I'll accept assignment and reset. Yeah, it's funny. I had mentioned I also picked up some Misty, which is basically covered calls, has about a 73 delta. I rather liked the idea that I would be milking a little bit of premium out. It does, the move does feel now, though, that we've kind of had this breakout and hit these new highs. Once that happens, I have a harder time sort of identifying what the upside boundary would be. So it's interesting. I own Misty, which had capped upside IBIT, but I was contemplating, didn't pull the trigger. But at the end of the day, I was thinking, I think I might buy some call spreads in IBIT or some call spread risk reversals. So essentially trying to get a little more bang for the buck right here. So, and that's essentially because we have a new regime, right? We broke out to a new high, so that just sort of resets my thinking about the whole thing. So more questions about the Kelly criterion. PC, I think this is an excellent question, and we will try to delve into that a little bit more deeply. I'll bounce it off of Mark, and maybe we can come up with a couple slides because, I take these questions as they come, but I'd kind of like to noodle on it a little bit more and also illustrate it because I've been talking a lot and I don't have pictures for people, and I have a feeling that people who are less familiar with the concept than you are might be getting a little lost on this one. So I want to make sure that. But I do like the idea that you adjust the amount of your wager based on how much you expect to make and how much you could potentially lose and the probabilities of each. Just in anything you do, that makes good sense. The Andrew, so with crazy volatile, but my favorites like, okay, let's see, put some of these things in here. What kind of spread? Seems like I get wiped out eventually doing anything. So there's two parts to this. So when you have highly volatile stocks, if what you're doing is you're buying expensive options and taking a punter on a direction, you can get two things wrong. Three things can happen, right? The stock can do nothing. It can go in the direction you thought it would, or it can go in the wrong direction. And if you're buying options that are really expensive, 2 out of 3 are bad. I'm guessing this has happened to you based on your comment. Now, part of that I can do nothing about. So if you're making directional bets this way or that, and your timing you never seem to get it right, that I can't help you with. But what I can do is I can say, look, one, absent a catalyst like earnings where you can, and those are the types of situations where I don't like being short premium because you could lose a lot more when you're wrong than you can make when you're right. But absent that, you'll notice that most of the things I come up with often have a short premium component in them because I'd like to get paid to be in my positions. Like the target trade, right? The target trade, we were generally bullish. The idea was we think the stock's going to go higher. We're willing to have it put to us lower. Earnings came out disappointing. Stock was down 4 or 5%, but the trade was still profitable because of that decay. Had the stock been up, we'd have made a lot more money. So that's, this is not win-win-win, but it's win-win-lose, meaning that, just improve the odds a little bit. How could you improve the odds? One, you could do things like call spread risk reversals, incorporate a little bit short premium, or upside calendar spreads if you're making bets to the upside. The other thing you can do, and this is a fairly straightforward thing, you know who always used to do this? When Options Action, the show, first came out, the original participants on that show were Dennis Davitt, who never ended up showing up because he worked for Credit Suisse, and Credit Suisse decided at the last minute he couldn't do it. And Stacy Gilbert, who worked for Susquehanna, who just took a job, I think, at the OIC, the Options Industry Council. Stacy was longtime trader at Susquehanna, which is one of the preeminent options trading firms. And when she came on, her favorite trade was using in-the-money vertical spreads. And the reason she did that was because when you do that, you can significantly mitigate the extrinsic. You can still manage your risk, but you can mitigate the amount of extrinsic premium that you're spending. So let me use an example. And I can do it really short-dated because when you do it in this way, you're not going to have a huge decay situation to resolve. Okay, so here's a trade where I'm looking at, say, a 25-30. Let's just use a 25-30, just keep the math easy. 25-30 call spread. Okay, stock has to go up to 26.25 by expiration, which is June 6th. So that's going to be 2 weeks away, basically, for you to break even. If you bring the long strike down, the upside break even will also come down. If it doesn't do that here, that's only because this is using closing prices, and the bid-ask spreads and some of these things might be getting a little bit wide, because I'm going down to like the 22.5s, for example, and so now the upside break even is going to be $3 higher than that, which is 25.5. Basically, it's not even. So now you're putting out more premium, but your decay is considerably less, right? So the upside break even here on this trade is going to be 25. Yeah, so it's not quite 25.5, 25.40, right? Because this is thereabouts. Yeah. And so that's one way that you can mitigate the expense. And the other thing is that if you're dealing with a highly volatile stock and you're trying to do this around a catalyst, I like that a little bit better, partially because one of the things that will happen if you use verticals, you can set up a vertical spread that looks really attractive on a risk-reward basis. But one of the problems is if you're just looking at the payoff at expiration, the instantaneous payoff may be very, very different. And to illustrate that, let me just punch this one out in time a little bit. So you see this curve here? That curve is what the P&L would look like tomorrow. Let me blow this up again. That curve is what the P&L looks like tomorrow morning. You put this trade on, that's how your P&L is going to behave. It's pretty close to the break-evens because this thing isn't far from expiration. The problem is that if I punch this way out in time, watch what happens to the shape of that curve. You see that? Now that thing is completely flattened out. So really what you're doing is you're just reducing your delta in a trade like this one. So if you're really trying to make a short-term directional bet, you're concerned about the fact that you've been losing so much in decay that you just can never seem to get it right. This is a way to mitigate that, but don't go way out in time, because what's going to happen is you're going to lose the whole benefit of having options in the first place. I'm not saying there's anything wrong with a trade like this, but given what you're telling me, I don't think that's your objective, but you just end up getting this really flat. It becomes almost linear. I mean, if I punch this thing out in time, eventually that's what that becomes. See that? Oops. There we are. See, that thing basically just flat from here to there. And this is a pretty big swing in terms of prices that we're talking about. And this thing's way in the money. I mean, look at this. This is, we're talking about with the stock at 50, we're short the 30 calls. And still, it's not going to go anywhere near the total value of that that call spread. You're not going to be up near the upper end of this range. So things to think about there. Hopefully that helps. Let's see. Do I have one page? Okay. Mike, Bitcoin broke. Ethereum MicroStrategy is down $20 at the close, 422 to 402. What leap call option would you recommend? Your year-end price target is 100 and... Oh, okay. So your estimate is right in the middle of, I guess, what you must have some analyst estimates there. So you're thinking 150. All right. Well, let's think about this because, again, I don't have Bitcoin options up here. So let's just do this. So I just want to walk everybody through it. This is true whenever you're looking at using an ETF to trade some proxy, whether it's USO to trade oil, UNG to trade gas, whether it's IBIT to trade Bitcoin, GLD to trade gold, whatever. You know, the first step is just to sort of think about things in percentage terms. It's not perfect, but it's a good place to get started. Okay. So where do we close today? We closed at 108.16. Oh, we didn't. Well, let's see. 108. Let's call it 108.170. You've got a price target of 150. Let's just call it 108. So you're thinking up 39%. So 39% versus 6180. So that takes you to $86. So, all right. So here's the trade-off. Let me do this. You're thinking, just want to make sure I got this right. What leap call option would you recommend? Okay, so you're just looking to pick a single call option. Well, this is an interesting thing, okay? Because one way, in a set and forget sense, if you have a definitive target in mind, let me give you an example, okay? Let's leave Bitcoin out of it because Bitcoin has some uncertain future. There's a lot of volatility around whatever that future is. But let's assume for the sake of argument, just for now, that there was no uncertainty at all. What would be an example of a situation like this? Let's imagine that you were looking at a company and you knew the company was going to be acquired. And better than that, you knew when and for how much. And the only thing you could do was trade options that expired at or just beyond that future event. And you could only trade one of them. How would you pick which one would be best? Well, the answer is, if you know what its value will be, what its terminal value will be, you can calculate backwards which one has the best return. Hopefully that makes some sense to everybody. So what did I just say the value of this thing was going to be? 80 something? Just go 1.4 times 60, 180. So 86, yeah, $86. So I'm just going to pull the strike up, and what I'm going to do is I'm going to grab a bunch of options, and we're going to think about that situation for just a moment. Let's do this. So I'll bring up a spreadsheet. Let's find a new tab here. We can assume it's going to be most likely an out of the money call that's going to have the best return. Oops, where did my spreadsheet go? There we are. All right. All right. So what we are now going to have are a bunch of options. And actually what I should have done was I should have just actually created a little formula to do this. Let's see. I don't want to bore you guys with that. That doesn't normally take me that long to do it, but it's probably easier if I just copy it and a whole bunch of these things over. So I'll take this up to say 70. Let's clear that out for a second. And what I'm going to do here, I'm not going to take all of them, but I'm just going to use this for purposes of illustration. I'm going to dump a whole bunch of options over here. So up strike, and is it op px mid? Bear with me, I'm just going to see if this pulls up the value I want. Op price mid. What about bid? Give me a price. Give me a price. All right, I'm not getting a price, so I'm just going to populate those. My data API is crapping out on me. So I'm just going to put some prices in, and I'm going to show you what I'm talking about here. So the 70s are trading about $8.50. 71s are trading, we'll call it 8.25. These are trading 795, we'll call it, 770, 740, 715, and so on, 690. You guys are going to figure out what I'm doing here in just a second. It'll make intuitive sense to you, I'm sure. Okay. Oops, that was the price. That's not what I wanted. There we are. So we're going to put the op strike price in here. Now hopefully this, I am trying to remember these okay, so I'm trying to call on fields by memory. Oops, that was well done. All right, so here's the things to think about. This is the price of the options right now. Here's the strike. We've already established that the terminal value is going to be, we'll call it 86.25. That's your percentage change, okay? So what is the value of this put going to be as of the expiration? Well, it's going to be either 0 or it's going to be the difference between E string 1 and the strike. So that's the value of the option at the end. And this turns out to be, that should be a percentage. I should actually do this. This is going to be your return on those options. Notice anything? So, and this probably doesn't come as much of a surprise to you. Okay, one of the reasons it's probably not coming as much of a surprise to you is because this 80 strike option is $10 further up than the 70, but it's only $2.50 cheaper, right? So your returns actually favor, in this high vol environment, lower strike calls, believe it or not, in terms of the percentage that you're likely to make. But this is a way to think about it if you knew what the future held. Now you don't, of course, because you don't have a crystal ball. If you do, give me a ring. I could use that myself. But this is what you're really trying to do. You establish what the terminal value that your forecast gives you and compare that to how much you're spending. Now, the truth is there's going to be some uncertainty, and this is the interesting part, is that if the terminal value you have is correct, your return on capital will be better for those lower strike options. But those lower strike options also have a higher probability of profit. So my recommendation is that if you're making a bullish bet, that you don't go reaching for crazy way out of the money call options, because I have a feeling that's going to be a painful exercise. There's something else, which is as a percentage of their own value, they're going to come in a little bit more. I'd much rather that you get something that is going to cost you a little bit more up front, but has a higher probability and look to spread or roll through time than just going out and reaching for the moon, if you will, by saying, oh, it's definitely going to be up 40% by the end of the year. And as you can see, this is true even if you did know that with certainty, which of course we don't. I hope that helps. Okay. Steve Pernnod shared a Kelly criterion for Bitcoin with the power laws metric. Okay, yeah, I like using the power law. I know that Mark likes to do that. I think we actually had that illustrated here. Nice online YouTube video. I'll look for it. Thank you. And actually, by the way, Mike, if you have that and other people might be interested, drop it into the comments below. There might be other people that would be interested in that as well. Look up the Kelly criterion if you want to familiarize yourself with it. And I think I will discuss the Kelly criterion with Mark as a potential topic for Friday, because I think that'll be interesting. And actually, that I want to bring up one other thing. So next week is Memorial Day. Someone get in my ear if I'm wrong, but I think it's Memorial Day on Monday. So there's no stream on Monday because our producer folks are going to be out. But as it happens, I am going to be on a business trip to Las Vegas, and I have a meeting in Las Vegas on Wednesday at 12:30 local time. So if I have a meeting at 12:30 local time, there's almost no chance I'm going to be able to do the live stream on Wednesday. I will talk to the producers and figure out whether we can find a different time to do it, whether we push it off a little bit later or do it a little bit earlier or jog it by one day to accommodate the holiday. So I apologize for that in advance. But actually, I'm meeting with some Bitcoin people who are setting up a Bitcoin volatility trading hedge fund. So that should be interesting. Let me see. I skipped a question here from Monday Morning Quarterback, I've been told. I think. Selling SPY call spreads seem to have good risk profile. Your thoughts? Yes, I do like that. Bear in mind that I'm a little bit jaundiced because what did I do today? I bought put spreads in SPX, which is sort of the debit version of selling call spreads. So yes, I like being long, higher strikes, short, lower strikes in SPX, which you are doing whether you sell an upside credit call spread or you buy a debit bear put spread. You're essentially trading the skew side, getting short the lower strike. So I like that. Obviously, I'm kind of skeptical on the market right here, just feeling like we got a little bit stretched. But I'm, influenced a little bit because I spent a little bit of time listening to Leo Cooperman of Omega, the former head of Goldman Sachs Asset Management, a guy I have a lot of respect for. And, he was trying to give some historical perspective on where we are in the fiscal crisis. And the problem is when you listen to somebody like that, you become very convinced. So I put a couple put spreads on small right before the close, SPX, despite the fact that we were down, thinking, yeah, I kind of agree with you. But, yeah, I like that idea. Now, we actually, unfortunately, have a hard out today because our producer actually has to move on to something else, so I'm not going to be able to get a whole lot further. I am going to take a look at some of these. I'm going to try to save what we have right here, try to incorporate it on Friday. But I think the thing I'm definitely going to try to touch on is we will talk about Bitcoin. We will talk about the Kelly criterion because I think it's a really good and interesting topic. Mike, so you are attending the Bitcoin conference May 27th to the 29th. Oh, you know about the conference. Yeah, so the conference is going on. I was going to attend. I didn't actually register to attend that, but I'm going there to meet other people who are in the space. I think I don't know whether we're going to be at the conference or not. I will actually find out. Maybe we will drop into it. But yes, that's right. There is a conference going on in Las Vegas next week. And I'm going to be in Las Vegas next week to talk about Bitcoin. But we're also going to talk about it here on Friday with Mark during office hours. So like, subscribe, notification bell, and tune in for that one. We'll see you here. Thanks for watching.